Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm glad to have with me once again Dr. Robert McHugh. Dr. McHugh is president and CEO of Mainline Investors, Inc. He founded it in 2003 to provide technical market forecasts for stock and precious metals markets, offering trading education and platinum trading services for subscribers interested in managing a speculative segment of their total portfolio to achieve above average returns. And I would suggest to those listeners out there that you take down the website to go to avail yourself to some free information that's there, as well as sign up for Robert's service, as I have done. I must say that, at least from my perspective, it is very much worth every nickel that I've paid Robert. That website is technicalindicatorindex.com, technicalindicatorindex.com. Dr. McHugh is, in addition to his newsletter, has also written a book called The Coming Economic Ice Age, 5 Critical Steps to Survive and Prosper. We have spoken to him about that in the past on this show. Before 2003, when he started his newsletter, he was the founder and chief financial officer of a regional bank in eastern Pennsylvania. Main Street Bank Corporation was the name of it. And he was the president of Main Street Investment Corp. And prior to that, Dr. McHugh was chief financial officer for National Penn Bank Corp. And his daily newsletter, which is what I'm talking about, what I subscribe to, the Technical Indicator Index, is a must-read for everyone who watches the markets closely and desires to stay ahead of the herd at every market turn. And I must say that every market turn, Dr. McHugh gives you almost a daily missive, and it's one of those can't-miss newsletters that I look for in my inbox every day, and he provides a very, very thorough report, but also an executive summary for people that might have difficulty in spending the time that you certainly could spend going through this very extensive letter. Welcome, Robert. It's really good to have you with me again.
Thanks, Jay. It's always great to speak with you.
Always good to talk to you, because I know that that you're a person of integrity and one that seeks the truth, not necessarily the things that you might want to believe, but the truth is the truth, and it's not a wishy-washy thing with you. So that's one of the things that I appreciate very much about you. Before we get started with our discussion, I should tell my listeners that this interview is being recorded on Wednesday, January 14th. So with the markets changing very rapidly these days, some of what we say could actually be out of date by the time this actually airs, which is next Tuesday, the 20th of January. So just for those of you listening to this interview, I'd like you to keep that in mind. But of course, again, that's one of the reasons that I think that you should really sign up for Dr. McHugh's letter, because whatever happens between the time of this interview and next Tuesday, you can be sure that he will have commented on it. I would like to start out, Robert, perhaps talking a little bit about your January 1st, 2015 missive that was sent out to your paid subscribers. It's kind of a big picture forecast for the markets this year. You said that you believe there will be at least one stock market crash this year. How do you define a stock market crash?
Jay, I measure that as a decline of 15% or greater. The stock market crash that I expect to happen later in 2013, I think, could be greater than 15%. I think it could be a big boy. Whereas we could have a mini crash or two before then that could hit 15%, or maybe they'll just be sharp declines, corrections in the 10% area. But I see a series of troublesome declines over the next several years, and this is the year that I think we're going to really start seeing it in full swing.
What was 2008, 2009 then? Was that a warm-up?
Yeah, it was. It was. They call it the Great Recession. I think we're still in it was the start of a Great Depression that we're still in for most people. And that was strike two. Strike one was in 2001 with the 9/11 event and the stock market problems that occurred from 2001 to 2003. That was strike one. The next one, 2007 through really 2010, I guess 2011 was strike two, and that was worse than the first decade, the first one of the decade. And then I think this one's going to be far greater than the last one, and this is going to be strike three.
No, on strike three, meaning you're out, meaning there could be some very major changes on the basis of what I read, probably political, economic changes, the likes of which are hard for most folks to imagine. And we don't want to be alarmist. We certainly don't want to see the kind of problems that you see on the horizon come, but at the same time, we also, if they're going to come, we want to be aware of them and be prepared as best we can. So, I'd like to ask you you have a lot of colorful pictures, not only literally colorful charts and things in your service, but also colorful words. One is a Hindenburg omen. Can you tell our listeners what a Hindenburg omen is and why it is something that you keep a very close eye on?
Yes, the Hindenburg omen is a series of conflicting an indicator lineup. It's a convergence of indicators in an odd way that tells us that the market is in a unhealthy condition that has been seen before all but one of the stock market crashes and major declines over the past 30 years. And that's as far as my data went. It probably goes even further than that. But it's a condition in the market where we have a battle going on between bulls and bears that is unhealthy. And we've seen this about 1 out of every 5 times we see this Hindenburg omen set up. We get a stock market crash, a crash for the ages. And then about 70% of the time, we're going to get we see a major decline afterwards, 5 to 10%. So when I see these things, I get very cautious and concerned because it's pretty much impossible, or we haven't seen crashes if this isn't going on first. So if we don't have a Hindenburg omen on the clock, then we can be feel fairly safe about very, very low risk of any kind of a crash. But when this condition is in place, then we have to, pay attention because it's kind of like if you were going to the doctor and he says, I got to recommend surgery, you got to have a 1 out of 5 chance you're going to die. I don't think any of us would like those odds, even though it's 1 out of 5. The damage, the danger is too great to take that chance. And it's kind of a financial death when we have a crash. So we have, interestingly, 4 Hindenburg omen observations. You need 2 to have an official Hindenburg omen. We've had 4 so far in January 2015. We had one yesterday. We had the one the day before. We had one on January 5th and 6th. So we are on the clock now where we could have the potential for a stock market crash or major decline sometime over the next 4 months. These are the life cycle of the Hindenburg omen is 4 months. But what's really interesting is we also have one on the clock from December. We had I forget what it was, 8 or 9 observation omen in mid-December, and so that's got a 4-month shelf life. So we have concurrent, separate, independent Hindenburg omens. I don't think I've ever seen this before. From December and January of this year, warning that the first third of this year, at least, the stock market is in a very precarious position, and we've seen that in the last, few weeks. I mean, it seems like every single day the stock market's going up or down 300 points, 200 points. I mean, yesterday it was up 300 in the morning and then down over 100 at one point in the day, and I mean, it's a 400-point swing down. Today it's down 300 at one point. Very, very volatile, and this is a sign of a very unhealthy market. This is just the shot above the bow. This is just a warning. It reminds me of 1987. If you study 1987's crash, there were a lot of hiccups where you had this enormous 300, 200-point. In that case, it was a lot smaller because the market was lower. But let's say 1%, 1.5% to 3% moves up, down, up, down, up, down, day after day for a few weeks, and then it crashed. It just threw up. It's like somebody who's sick and you're gagging. I hate to use this reference, but and then you really let loose. And that's kind of what I fear I see in this market right now. And this ties in with a lot of patterns and so on that we've been tracking that point to 2015 and the next few years afterwards. as being a very, very dangerous investment market for the stocks and the economy as a whole.
Mm-hmm. It's sort of a manic-depressive market, isn't it? And I think if one of the items, and you go into this in your newsletter, one of the components, one of the major components of the Hindenburg omen is sort of the spread between the number of new highs and new lows. Isn't that part of it?
Yes, but there has to be a minimum of new highs and new lows have to both exceed 2.2% of total issues traded in a day. Now, that may not sound like a lot, but that's a lot to have both new highs, new 52-week highs, and the number of new 52-week lows, both over 2.2% on the same day, is an extraordinary, bizarre event in the stock market.
Mm-hmm.
Now, that in itself does not create a Hindenburg omen. There have to be several other conditions.
Sure.
But that's the primary one we watch for. That's the first thing we look at.
Yeah.
And when all the conditions are in place, it tells you this market is sick. It's in trouble. It's unsafe. It's at risk of dropping hard.
Mm-hmm.
There's something not right in it, and we're in this condition right now.
Mm-hmm. In your letter, the January 1st letter, you talked about the likelihood, I think, during the last third of this year, as being the most likely time when we'll see a stock market crash. I'm wondering, you say we have these various Hindenburg omens that have occurred. Two questions. One is it more likely we'll have a crash if there are more Hindenburg omens? And secondly, how long do Hindenburg omens stay on the clock?
They stay in the clock for about 4 months, so that means if I'm calling for a stock market crash later in this year, we'll probably have another Hindenburg omen later in the year.
Mm-hmm.
Not necessarily. There was one time we've had a crash in the last 3 years without a Hindenburg omen. It was a very brief crash. It dropped 17% over a couple of weeks. But, so it's not a guarantee if we don't have a Hindenburg omen. We could still have a crash. So it's about a lifetime of 4 months. What was the first part of your question again?
The other one was, is it more likely that if there's more than one, that it's more likely to have a crash? Statistically, in the past.
Actually, what's interesting is you just need 2 observations within the 30-day period. You can only have 1 observation, a maximum of 1 per day. So you have to have 2 days of this condition. But I've seen where we've had 17 observations in a month, and we've had 2 observations in a month, and the stock market fell harder after 2 observations than it did 17. So we can't really get comfort that, we haven't had 17, we're safe, we only had 2, or we only had 4. When you see 2, it's just as dangerous a condition as if we had 17.
Another very colorful image in your book as well as in your newsletter, you talk about a decades-long jaws of death formation, also known as a megaphone formation to technical analysts. That it really has you worried. Can you talk about what this is, the jaws of death formation, and why is it so important?
Yeah, this is jaws of death pattern is a megaphone top. It appears at major tops, and inevitably, whenever we see one of these, we have had a stock market collapse and an economic collapse, a major recession or depression in our economy over the last 115 years, ever since 1900. And it was there before the stock market crash at 29. It was there before the crash at 87. It was there before the crash of 2001, the crash of 2008. And here's the thing, those were small patterns. Those were patterns that took place over a few months to a year and a half. The one I'm watching has been underway since late 1980s, and it is massive. It is unbelievable. It is huge, and it is done. It is nearly complete. It has pointed to a finish this year in 2015. It is essentially over. I mean, could it take another month or 2 or 3 to fully develop right along the upper sloping pattern's boundary line? Sure. But it's for all intents and purposes, this 25-year pattern, 27-year pattern is now complete. And that means that a major economic collapse and a major stock market crash is imminent. By God's grace, will He give us an extra 6 to 9 months before it really hits hard? I hope so. But we have got to get ready. The sign is in place. The warning is here. This pattern doesn't fail. I mean, this pattern's reliability is enormous. I wrote about it back in 2013 and 2014, said, warning. And so people bought my book, they've had a year and a half of preparation warning. Well, time's marching on here, and we're running out of time. This is really an imminent, dangerous situation.
You mentioned a moment ago that there's a smaller, if I understood you correctly, there's a smaller jaws of death within this larger decades jaws of death. Is that smaller one comparable to what we had at other times, the ones you're talking about?
Yeah, it kind of, it kind of is. What's interesting is we had a jaws of death before the collapse in 2001. That's part of this larger one. We had another jaws of death back in 2008. That small one was part of this larger one. Mm-hmm. Now, I've just seen another tiny one that formed over I call it tiny, the last 6 months. Since June of 2014, another one formed, and that's finishing up right now. Oh. So, I mean, I'm talking about the next few weeks. So, the size of the one that's started in June, we're talking 7 months, as was about, some of these jaws of death we saw over the last century that resulted in very, very strong declines were about the size of that one. That was more of a typical size jaws of death, what we've seen in the last 7 months. But this thing I'm looking at here that we're talking about, that's 2 decades, almost 3 decades old now.
Yeah, and that's why you think we're in for a very major event here, one that would, I gather, one that would be more significant even than the 1930s.
It is. It's much bigger than the one in the 30s. This is, and if you look at Elliott wave cycle analysis, the wave analysis, I don't have the time to go over it all, but let me just put it this way. There are different degrees of wave movement, of stock price movements, of cycles of prosperity and decline. We are wrapping up a 3-century bull market in the world economy and the stock markets that goes back to the 1700s. That's what this jaws of death, this 27, 28-year-old pattern is identifying, is the top and conclusion of a multi-century bull market for world economies.
Yeah.
And in Elliott wave theory, I have it's a grand super cycle wave 3 top. Mm-hmm. But the problem is, what follows a grand super cycle wave 3 top is a grand super cycle wave 4 decline. Yeah. And that's what we're talking about is imminent. It's coming. It's about to start. So that's where this danger is. This is why I'm kind of passionate here. It's really right here. With so many different studies, independent technical indicators, patterns. They have nothing to do with each other, and they're all saying the same thing. It's crazy.
Yeah, indeed. And I might just mention to our listeners that your warnings are very much akin to those of Robert Prechter, who's been on this show a couple of years back. And I believe he feels much the same way and sees much of the same thing that you're talking about. Another indicator you talked about, you also mentioned there is, quote, a second convincing piece of evidence is a cycle that is rare and extremely that correlates with the stock market declines and economic downturns. You say it points to a powerful economic and market collapse around September 14th of this year. Can you tell our listeners what that rare pattern that you're talking about that correlates so well? Can you pinpoint a date, and how can you pinpoint a date so specifically as September 14th?
It's a cycle pattern that was present in 2001. It was present in 2008. It's a roughly 7-year pattern. If you go back starting in 2008, and just go back every 7 years and look at what happened, it's incredible how within a year or two of that 7-year date, you see an economic recession or crash that can almost be marked all the way back to the beginning of the 1900s.
Yeah.
But it's more than that. There's a reason for it. I know it's going to sound a little strange, but it has something to do with the lunar alignments and the solar alignments, and a lot of it has to tie in with the Hebrew calendar, the Jewish calendar that God set up back in Genesis 1:8, where He told us that He's put one of the purposes of his creating the sun and the moon and the stars isn't just for light, but was for signs, where He communicates to us events that revolve around the Jewish nation and the Hebrew people that He has set in place in His divine calendar. He has an appointment calendar. He communicates these things, his events that He's setting up. And so some people know it as the Shemitah year, and it's extraordinary. And I've taken this very seriously, and I mentioned it in this write-up because we're scheduled for another event in this coming September. If you looked at 2001 and 2008 events, they also happened in Shemitah years in what we have as our month of September, which in the Jewish calendar is a different main month, but ties in with the feast, the fall feast of the Jewish faith, and this has to be taken seriously because its track record is amazing.
Well, that's fascinating stuff, Robert, and that and much more is what people get from your newsletter. We've got another 5 minutes or so, and we haven't even begun to talk about gold and silver, which your letter also focuses on to a very great extent. I'd say after the general equity markets, gold and silver is what you probably focus on most, but you seem to be a bit more bullish on gold and silver than you are the equity markets. Why so? If the rest of the markets are tanking, why should gold and silver run counter to the equity markets?
Because I think that gold and silver are going to be the future currency of mankind in some way, shape, or form. As economies collapse, as currencies collapse. You take Russia, what just happened with Russia. I mean, the ruble's collapsing, and it's because of oil, because they're so dependent upon their oil economy. You think they're just going to sit back and take this? No. They're at some point they're going to have to prop up their currency, and guess what? With gold. Well,
they've been buying.
What else are they going to prop it up with?
They've been buying and importing, and of course they have a lot of their own gold production. The reports I get is that both Russia and China even more so, have been importing and building up their stockpile of gold. Both of those countries, and then they're also forming alliances between the two of them to trade more with each other as they fear the aggression of the United States. At least that's from their point of view. So I think I am in total agreement. I think it's very interesting to watch what's going on, and they are certainly not sitting back, and they've not been quiet necessarily about doing exactly what you're saying.
Yeah, I mean, it's going to be self-defense when this whole world economy blows up, which it's coming, based upon all the other indicators and so on that we've been watching, and just empirical evidence and common sense and fundamental economics. You just see it. I mean, except for the $5 trillion that just went to New York City and 4 or 5 QE programs, three QE programs, depending on how you want to count them. $5 trillion went to New York City. It didn't go anywhere else.
Yeah.
So everything around the New York City metropolitan area, from Boston perhaps down to Washington, D.C., I mean, that's a third of the U.S. population. Yeah, they're doing fine. They're doing great. Real estate's going well. The price of short properties are through the roof. But the rest of the country, the middle class is being wiped out, and the rest of the world is in trouble. This world economy is about to plunge, and currencies are going to follow down. Paper currencies are not going to hold up, and that's just gold at some point is going to explode higher because it's all they're going to have left to turn to to back their currencies to keep the thing going.
You know, Robert, one of the things I've observed with David Jensen, who's on my show on a regular basis, is that from about the middle of December or so, gold has actually outperformed the dollar, even as the dollar has been outperforming other currencies. And David's suggestion is that there may be at the margin people that are starting to think exactly what you're talking about. So do you think we've seen the bottoms in gold and silver? The chances are what, 50-50 or better than that?
I think they're better than that. I have a price pattern that says that allows for gold's correction from September 2011 to be complete. I have it as a wave 2 down. Prices move in 5 waves. Waves 1, 3, and 5 are up, and waves 2 and 4 are down when you're in a bull market, and vice versa if you're in a bear market. Well, I think the last 3-4 years decline in gold was a wave 2 down, which was correcting a portion of the rally in gold from way back in the 2000 period.
Yep.
So we're ready for wave 3 up now, and I can look at a pattern, use an Elliott wave analysis, and say, yeah, that looks good, that looks complete. We're ready for wave 3, and then you look at the coming imminent economic collapse in the stock market, and gold does pretty well when stocks crash. There's an inverse relationship. Several crashes or major declines we've had over the last several decades, gold goes up, and I think that gold is going to have to be the safe haven, one of the major safe havens, and it will prosper as the rest of things start going down.
You know, gold has gone up, oil has gone down tremendously, which is very bullish for the mining companies. All of a sudden, the amount of energy costs that mines have to suffer through has decreased very dramatically relative to the price of gold. And, I think it's gone from something like 12 barrels an ounce of gold would buy to 24 barrels an ounce of gold would buy. And we saw after 2000, 2008, 2009, a dramatic increase in the real price of gold. So whatever the nominal price goes, as a person who looks at gold mining companies, I'm very concerned and very positive, actually, about what I see in the real price of gold for the fundamentals of mining companies. What do your technicals say about the mining shares, gold and silver mining shares?
Same thing as gold, up. We're ready to go. We're ready to fly. Will there be corrections? Sure. I also think this bull market in gold and mining could start out slow because there's just not enough trust. There's been so much beaten down psychology over the last 4 years. People are a little hesitant. It's going to be the pros that get in first. But there'll be a general following once people get convinced that the bull market's back. And so it'll be starting out slow on the upside, and then it's going to accelerate. And the other thing that's going to happen, too, is, and that's a great point you just made about mining stocks for the price of oil. That's a tremendous point. And then, the other point here is I think that the response of the central bankers all around the world when the economic collapse and stock markets collapse occurs later this year and so on, is they're just going to print more money.
Right.
And the more money they print, it's just going to feed the value of mining stocks and gold. So there's an awful lot of forces at work here, and you just brought up a great one about the cost of oil.
Yeah, let me ask you.
Forces at work.
Yeah, let me ask you what are your technicals saying about oil?
That's a great question. Let's go with that. Just turning my little analysis here. Okay, this one's kind of crazy. I do see it going down a little bit further. There's a couple of different possible patterns in the short run. Could be we're doing a large triangle pattern, and oil has some work to do on finishing that. I think that oil is close to bottoming. Does it go down to 40? Maybe. That would be okay. That would be part of a wave 4 down. But I believe oil is in a bull market, and I believe that oil, if it's doing a triangle pattern, it's going from about 40 to 95 over the next year or two, and then we'll drop down to about 70 over the next year or so to finish the triangle, and then I think it's going to 200.
Wow.
Or if the bottom is at 40 here, and it's not a triangle, but it's just an ABC wave 4, then we're going to 200 sooner than I think, And one of the main reasons I think we're going to 200 is because I think there's going to be a war. I think there's going to be a major war in the world, and that's going to be the result of economic strife and conflict and struggle from the coming economic collapse. I mean, if you go back through history, every single time we have economic collapse, the result, the consequence, unintended or not, is war.
Yeah.
And you can see, I mean, I brought up the example of Russia. They have such a highly motivated situation right now where their economy is in such dire collapse that they have an incentive anyway. I don't know if they'll do it or not, but they have an incentive to go down and take over oil-producing nations, just so they can control price, just so they can get back in control of the price of oil. And the thing is, if we have a war, oil is going to be needed to feed the trucks, to feed the machination, the industrial complex of war generation, of weapons production. And so I fear a great world war coming. And
I'm sorry to hear that.
I think that I am sorry to hear it too, but I think oil's headed much, much higher based on the patterns and based on the fundamentals of what war would bring.
Yeah. Well, we're just about out of time here, but I know that you're positive on U.S. Treasuries, dare I say also the U.S. dollar then as we move into 2015. What's your outlook for both?
I'm positive on Treasuries because I think it's going to be another safe haven like gold. Right now we have the strongest military on earth, I think. I don't know what's happened over the last 6 years with the new administration. Scaling back our military, it used to be the strongest military in the world. I hope we still are. So I think that bodes well for Treasuries, because the nation that has the strongest military, dollars will flow into that. You could say money could flow into it. You could say that same about the dollar, but here's my risk with the dollar. My charts are telling me that the dollar eventually is going to start dropping really hard. And I think it's going to be because the response to an economic collapse is to print more dollars, too many dollars, and that the forces of supply and demand will drive the value of the dollar down. Now, relative to other currencies, the dollar may hold up, but relative to the price of gold, it's going to drop through the roof, or drop through the floor. And relative to gold, gold's going to rise, the dollar's going to decline. So it depends on how you look at it, but I don't have a high. And here's the thing: if they print a lot of dollars, as we saw with the 5 trillion QE programs, this is one to know. You get hyperinflation. I mean, the middle class is getting squeezed because of all the inflation in necessities.
Yeah.
The quiet, unreported, inflation and go buy tires for your car. It now costs you $1,000 for 4 tires.
Yeah.
Go to the doctor bills, the medical bills. Just food. I mean, go to the grocery store. You come out of there with a $300 bill for a few bags of groceries. It's insane, the cost of living, and the CPI numbers are just lies. They're just bullcrap.
Yeah, they really are. There's no question about it. If you're an average person, you understand that. I think some of the people that I rub shoulders with here in New York that are certainly not average, that are very wealthy, they don't feel the pinch. But those of us who have to pay for things that average people have to pay for, it is really clearly the middle class is getting pinched, which leads me to real estate. Unfortunately, we're out of time, Robert, as I look at it, but I would just like to tell my listeners that Dr. McHugh wrote a splendid report on real estate, on the housing market, and keep in mind that Dr. McHugh was a banker himself, certainly does have a lot of knowledge of the markets, the real estate markets, the mortgage markets, and so forth, and the destruction of capital, as David Stockman has pointed out on this show, how the policymakers are really destroying capitalism by destroying and taking away the price mechanism, price discovery in the capital markets by manipulating the interest rates. So it all goes together. But I would just say to our listeners, since we don't have time to really talk on to touch on this today, sign up for Dr. McHugh's newsletter, and I'm sure, Robert, that you would send along the January, or that once they're subscribers, they can go into the archives and read your January 1st missive, which I think is just excellent, and that covers the real estate market. Am I right about that?
Yes, Jay, you are. Thank you. I appreciate that. Yes, it is an interesting piece, as you said, and I just think I'll quickly say Dodd-Frank killed the real estate market. It's a socialism piece of legislation, and that's why we had the problems we have today.
Well, yeah, this administration doesn't want to have people earn anything. They want to give it to everybody, I suppose, so that the government can control everybody. Now they're on to giving away college educations, financing that and everything else. Where does the money come from, Robert? How long can the parasites continue to eat away at the body, at the economic system that produces wealth and expect to still have wealth? I don't know. It beats me. I don't understand it. I guess we can talk about that another day because, unfortunately, we're out of time. I want to thank you very much for passing along your wisdom to our listeners, and I would really, once again, encourage people, technicalindicatorindex.com. Go there, learn what Robert has to offer, and sign up for his letter. Very reasonably priced letter, and those of you who might want to take his information and use it to make money with, he also has a program that will allow you to do that, more expensive one, but very much, I'm sure, very much worth it. So thanks again, Robert, for being with us today.
Thank you, Jay. It's always my pleasure. I always enjoy speaking with you.